Turn $200 a month into $500,000. The 7531 rule will show you exactly how. Alright, imagine putting money into your investment account every month, watching it grow for years, only to feel like it's barely moving. You're disciplined, you're consistent, but your balance looks underwhelming. And then, there's a moment, a specific point in time, when everything flips. Growth that once crawled starts to sprint. That's the moment most people either miss because they quit early, or they catch it and ride it to real wealth. Today, I'm going to show you exactly how to predict that flip, and how the 7531 rule can take you from a modest $200 a month habit to over $500,000. Let me explain. The truth is, compounding feels terrible at first. It's like pushing a heavy car. In the beginning, your legs burn, your heart races, and the car barely moves. But once momentum builds, it gets easier, and suddenly the movement is exponential. Investing is the same, but the problem is, no one tells you how long it takes before the wheels really start rolling. The 7531 rule fixes that. The 7 stands for 7 years minimum. That's the commitment you need before you can expect compounding to feel like it's actually working. 7 years smooths out the chaos of market cycles. In the S&P 500's history, every single 7-year period has had positive average annual returns. Less than 7 years? You're gambling on where you land in the cycle. Psychologically, committing to 7 years changes how you view your portfolio. You stop obsessing over small monthly changes and start thinking in decades. It's like planting a tree. You judge its health by whether it's still growing in year 7, not by its height in year 2. Now, the 5 is for 5 categories of diversification. Not 5 random funds, 5 distinct asset types that move differently, so when one slows, another picks up the slack. Broad market index funds, your foundation, historically returning about 10% a year long term. Dividend-paying stocks or funds, giving you regular cash flow, even in down markets. Small and mid-cap growth stocks, higher risk but higher long-term returns potential. International exposure, access to markets outside the US that don't move in perfect sync with ours. Defensive assets, bonds, treasury bills, or cash reserves that protect you during downturns. Diversification isn't just safety, it's resilience. Without it, the wrong collapse can wipe out years of gains and reset your compounding curve to zero. The 3 is for 3 emotional phases that will try to push you out before compounding works. Doubt, early on when growth looks slow compared to flashy, high-risk strategies. Frustration, mid-phase when returns still feel linear and not exponential. Panic, during inevitable market crashes when fear tempts you to sell. Surviving these phases is critical. You do it by not checking your account daily, automating your contributions, tracking progress by shares owned instead of just balance, and studying market history so crashes feel like part of the process, not disasters. Finally, the 1 stands for 1 annual contribution increase, the secret fuel. Even a 5% boost each year massively changes your end balance. For example, starting at $300 a month for 30 years at an 8% return gets you about $48,000. Increase that by just 5% annually, and you jump to $787,000. That's nearly double. For just a small annual adjustment most people won't even notice. Let's see this rule in action. Meet Veronica. She's been investing $200 a month for 5 years and has $14,000. Frustrated, she's tempted to quit, but instead she commits to the 7531 rule. She commits to 7 years minimum. She diversifies across 5 categories. She prepares for doubt, frustration, and panic. She increases contributions annually by 5%. By year 7, she has $24,000. By year 10, $42,000. Year 15, $89,000. Year 20, $156,000. And by year 30, over $500,000. In her final decade alone, she contributes under $75,000 and gains over $300,000 from compounding. Studies back this up. Fidelity found that investors staying consistent for at least 7 years had balances 60% higher than those who kept changing strategies. Dalbar's research showed that emotional, reactive investors earned barely half the return of the market itself. Vanguard data proves diversified portfolios see less volatility, meaning fewer panic sells. And Schwab found even a 1% annual contribution increase boosted wealth by 25% over 20 years. So imagine what 5% can do. But here's why most people don't do this: it's boring. It's slow. There's no adrenaline or quick windfalls. Our brains crave instant gratification. Compounding will frustrate you in the beginning, and that's by design. It filters out the impatient. The 7-5-3-1 rule is your roadmap. 7 years commitment to weather the cycles. 5 categories of diversification to protect and grow. 3 emotional phases to anticipate and overcome. 1 annual increase to speed everything up. Here's your action plan. Commit to 7 years minimum. Write it down and make it non-negotiable. Diversify into the 5 categories. If unsure, use a target date fund or robo-advisor. Automate contributions. Don't rely on willpower. Prepare for the emotional phases with a written strategy for each. Schedule your annual contribution increase and stick to it. Wealth built this way isn't if, it's when. The only variable is your discipline. So here's my challenge. After watching this, check your portfolio right now. Does it follow the 5 categories? Commit to hitting the 7-year mark. Increase your contributions today, even if it's just $10 more a month. Write your plan for doubt, frustration, and panic now so you can follow it later. Compounding turns time into money and discipline into wealth. Follow the 7,531 rule and you won't just hope for financial freedom, you'll build it. If you found this helpful and want more strategies to grow your money and your mindset, subscribe to Knowledge Quest. And if you want to learn how to start and scale a YouTube channel to add another income stream, I've opened a free community sharing all my proven techniques. The link's in the description. This is not financial advice, just education backed by data and experience. Your results depend on your actions. Start now, stay consistent, and let compounding work its magic. Question for you. Which part of the 7-5-3-1 rule will you start applying today? Drop in the comments. I read every one. And I'll see you in the next video.